about Wuhan virus, SARS-2, COVID-19? Did we miss that off our forecast?
I don't recall that coming up, if I'm honest.
My sort of telescope in the future. Earth to David, Earth to David. Welcome back, everybody, to the 12 Days of Property. And today we have an extra special guest for you. We have Kwasi Affum, who is an investment banking strategist. Now, Kwasi, the first thing I've just heard in my ear is everybody saying, what's an investment banking strategist do? Could you describe what an investment banking strategist does?
Yes, I sure can. And I guess firstly, thank you, David. Thank you, Andrew, for having me. I've been enjoying your 12 days, so I feel honored to be asked to be on one of the days. And to answer your question, so what do I do? I guess I'm a property investor as well, but separately to that, what I do professionally is I do something called horizon scanning and strategy for investment banking. I look along the horizon at events that might occur, highly probable or otherwise, and then define a strategy to deal with those events. So to give you an example, something that I had looked at or started looking at in December 2019 was something that was going around in China, then called the Wuhan virus. Then became Corona, then became SARS-CoV-2, and as we know it, COVID-19. And so just basically looking at things like that, initially looking at what is it, can it affect us as a business, our staff in certain locations like China or India as the first point. And these are kind of different orders of impact, if you like. So first order of impact would be, how do we deal with it if it hits our office in that location? Second order of impact might be actually, what about our offices in other locations or our businesses in other countries? Third or fourth order impacts might be, well, actually, this is going to impact our consumers, our customers. How are they going to deal with it? How is them dealing with it going to impact us? So if they lose their jobs as a result of coronavirus and can't pay their bills, that affects the debt that we hold, which then affects us as a business. So different orders of impact, looking down the horizon, understanding what they mean, and then coming up with a strategy to deal with them. Hopefully that's clear.
No, that's brilliant. That's a really good definition. So effectively, you're a futurist. You're looking at the future to work out what is likely to happen in the future. Now, if I wind the clock back, and just before we came on this recording, we were having a brief chat, and around about 13 months ago, December last year, and you mentioned December last year, a Wuhan virus, we met at a private event where David and I were guest speakers. It was David's event that he'd created, bringing together a panel of 5 experts. And you were one of the guests in the audience, giving us a good grilling. I'll drop the link to that previous set of forecasts there. Now, you had the benefit of being in the audience to ask the awkward questions. Do you think we got it right? Did we nail 2020, or did we forget about Wuhan virus, SARS-2, COVID-19? Did we miss that off our forecast?
I don't recall that coming up, if I'm honest. I don't remember SARS-CoV-19 2 specifically being mentioned. No. So I'm not sure why you missed that. How could you miss that?
My sort of telescope in the future just wasn't working. Sorry.
Yeah.
So,
but here's the interesting thing. So we joke about this, but the interesting thing is, so for example, I think it was in December when there was just a memo about a virus that was going around in Wuhan, and it was only relevant because if you're traveling if you're a foreign traveler traveling into that area, something that you have to be wary of. So it's not something that anyone in that moment could have predicted would be where it is now. But it's at the same time, it's not something that you could necessarily not be aware of. For example, if you're in government, or if you're in the foreign office, or if you're so it's really interesting when you think and look at these things that actually, for some people, yes, you definitely don't think about it, don't know about it. But for other people, they should maybe have been more aware of what was going on with this virus, and therefore been better prepared come March.
Perhaps, to be fair, I mean, if we'd compared it with SARS and MERS, they both fizzled out quite quickly, and if and it was a similar kind of virus, so you know, it was perhaps that was the early expectation of it.
Yeah, I mean,
so unfortunately for me, the sad thing for me is that I live with data, and so I never like I'm not the type of person that has an opinion and then that's my opinion, because I know that tomorrow I might get a whole data set. I might think the economy is doing really great, and then tomorrow we get a whole series of data set around consumer spending, credit card data, business bank account data, and it's a total different picture. I need to come up with a strategy for that new scenario, not have my perception in my head. Yes. So to your point though, David, I think first, my opinion was that it's similar to, my first piece of analysis was that it's similar to SARS, maybe similar to MERS, and maybe similar to bird flu. My second piece of analysis was that it's not similar to those. So the data changed. The information I had changed. It was a lot more contagious and it was a lot less deadly, for example. But those are two different things. In fact, we know, anyone who knows viruses know that the best viruses are not deadly. The best viruses are not deadly and highly contagious, because the virus needs to keep its host alive in order to be able to spread, and needs to spread to as many people as possible. So kind of ideal state for a virus is not to kill your host and be very, very infectious. We've always known this. Now, it's interesting, if you look at this mutation they're talking about for COVID-19, what are they saying about it? It's no more deadly. They're not saying it's less deadly, but it's no more deadly, and it's highly more contagious.
Yes.
So I could, if even before this COVID-19 virus was discovered, I could have told you that was the pattern for viruses. So nobody should be surprised that the virus has mutated to become more contagious, because that's the pattern for viruses.
Right.
Like, this is, when you talk about futurist, it's a really cool title to have, but it's really not that difficult, because things don't repeat themselves, but they rhyme. And if you just follow the rhyme pattern,
sense. A lot of it's common sense, isn't it?
Yeah, yeah.
But let's go back to the fact that you're a property investor and you're a futurist, you're a data analyst on a macro scale.
Yeah.
2021, two questions. What are you doing as a property investor? Because we talked about what you were hoping to do last year, and sort of the wheels fell off as your valuation on the day of lockdown got cancelled. But what are your plans for 2021? And what are your predictions for 2021 as a futurist? Do you think Brexit's going to be doom and gloom on the economy? COVID's going to help? Landlord taxation? Planning changes? I mean, I'll throw out a load of different things. Pick the thread that you like and tell us your professional opinion.
So firstly, I'm not a doom and gloomist, right? I don't believe in doom and gloom. My scenario is always good, better, even greater. I'll give you, like, Brexit is a good example. I never voted for Brexit. I would never have voted for Brexit. Not because I'm against if I was Prime Minister, I would have gone for Brexit. But as a civilian, I would not go for Brexit. I trust myself to execute a great Brexit. I may have trusted someone else to do the same. I just didn't trust these guys to do it. So I never voted for it. Nevertheless, Brexit was never a disastrous scenario. Brexit, regardless, is going to end up where it ends up, and it's not going to be disaster. But the question of where are we going to be? Are we going to be growing at 3%, 3.5%, 4%, 5%? It's not a question of are we going to grow or are we going to stagnate, right? So that's kind of my position. And if I look at 2021, it's exactly the same. I think we've had great times in 2020 in terms of property. To answer your question very specifically, one of the things that I'm looking at is rebalancing my portfolio. If I look at some of the areas that have had really strong growth in 2020, there are some that I think are going to continue. The Midlands had really good growth, for example. I think that area is set to be strong going forward. London didn't have such great growth during 2020. If you look at a lot of coming to the macro, one of the interesting things about the people who have been affected by COVID-19 is that it's disproportionately affected poor people. It's disproportionately affected people in lower incomes. It's as bad as that is, it's just a fact. You know, like I say, I look at the data, that's just what it is. What does that mean? It means that a lot of the people buying property are people in higher incomes. People who haven't been furloughed, have been able to work from home, and haven't probably increased their income as well as their savings during the pandemic. Those are the people in the market. So that's going to skew the market in a certain direction. They're going to be looking, the other thing we know is that more people are working from home. So those people who are white collar are going to be looking for certain type of property in certain type of areas. Again, skewed away from the people on lower incomes. So these are just what we know. And so that tells us something about the type of places, areas that are likely to see high growth. So for me, the key thing is rebalancing my portfolio. I'm looking to sell some properties, maybe buy some in a different location that maybe position me for the next 5 to 10 years, as opposed to the last 5 to 10 years, which is what I had been doing. I'm very lucky, I guess, because I work on a 5-year plan in my property business, and my last plan took me up to the end of 2019 or 2020. So the next plan starts from 2021. Lo and behold, we had a catastrophic event that meant that I had to replan anyway. So yeah, right on cue. And so yeah,
I was going to say that's good to be on cue.
Will we see the growth rate we've seen this year? Wouldn't surprise me if we did, to be honest. I think we have things like the stamp duty holiday, which is going to take us through to March. That's led to reduced purchase prices for me in the area I look by about £15,000, which is a lot per property. So, you know, and it's no coincidence that average prices in this country have gone up by about £14,500. So there's a lot of synergy there. I think that's going to continue. It's probably going to, I anticipate that we're going to get the peak housing price rise probably in March, actually. March is going to be the peak month. But as people try to complete as many transactions as possible, bring forward, I think that we're going to bring forward a lot of purchases from the first half of the year into March. So probably from April to June, you're going to see a fall in volumes, maybe not necessarily prices, but definitely in volumes. And so for me, actually, one of the things I'm looking to do is put some things on the market between January and March, well, between January and February, actually, try to complete before that March date. Because I think that's when we're going to peak. I mean, that's very specific to me and what I'm doing, you know, today, right now, literally on my phone.
I know that some law firms, some law firms have actually stopped taking instruction already for selling properties because they can't guarantee they'll get off the line. So you've got to have some sharp people and keep ringing up the phone and pushing them.
Yeah, exactly. The law firms, yeah, I know some surveyors who've done that. I think it depends, obviously, on what type of solicitor they are. A lot of the residential ones are not necessarily prepared for this. I bought, you know, the last time we had the stamp duty holiday in 2016, I bought 2 properties on the one on the 30th and one on the 31st of March.
And so, another very important tip, just quickly here, which you might not be aware of, you'll know when your solicitor's going on holiday. Make sure you know when the other party's solicitor is going on holiday as well, because with this critical timing you got on this one, that can be crucial. Exactly.
I mean, you hope that your solicitor has backup and cover while they're on holiday, and it's not just a dead end. But
indeed, yeah. Indeed, it has happened to me.
Oh, really? Wow. Yeah. Many things have happened to me with solicitors.
You'd be surprised.
Let's have a look at reserves, Kwasi. I mean, are you, by selling some and relocating to other areas, you've intimated it might be London you're selling and move into the Midlands. Is that to reduce gearing? Is it to increase cash reserves? Or is it just to get better yields or better capital growth? What's the reasoning behind that?
So one of the things, like, you lock in your yield when you buy. So I'm really lucky. I've got some really good yields from some of the properties I've bought in the last sort of 6 years or so. But also, if you want to sell in future, the yield is important. So, you know, in London, we had some great growth. I know that for anybody buying any of my properties right now, they're probably getting half the yield I got when I bought them. And so in the future, you know, if you look at that cap rate, it's going to make it more difficult to sell.
Yes.
And so that's something that plays on my mind. Not just people often think about their own yield, what they're getting, etc. But if I look at the exit strategy, I need to be able to sell it to an investor probably, and that investor needs to be able to get a good yield. And so is that probability going to increase going forward? We're talking about, I think, property prices going up maybe 4, 5, 7% like they did last year. What does that do for the yield of anyone looking to buy, not just now, but in future? And at the same time, I can look at the other parts of the country and look what yields are doing there. You might get places where actually prices haven't increased that much, but rents have, and yields are going up, and there's a strong growth rate in the yield. So for me, like I say, it's more about balance. So I'm not looking to sell everything for sure. But at the moment, I should say, actually, when I started, I had a very localized strategy. I'm in London, more specifically, I'm in Northwest London. It's very capital intensive, should we call it, to acquire property in this area.
Yeah.
I think you know somebody who's not far from my area in Harrow. And so, there's a challenge there. And I've been lucky and fortunate enough to build up here, but that doesn't mean that this is where the future growth is going to come. So just about rebalancing the portfolio. For price of a property here, you could probably buy 2, maybe 3 in the Midlands.
Yes.
So it's not necessarily about gearing down, but it's just about rebalancing.
One of our guests earlier in the series was in the process of relocating from London to the Midlands, were they not? As they were doing the interview, they were kind of living out of a suitcase that day while the moving was going on.
Absolutely. And
I'm not sure about relocating. I think I live in Northwest London in Harrow. I live about 10 minutes from the primary school I went to, and
nice.
I got married down the road. My son, actually, the headmaster, was my teacher in primary school. So I haven't gone very far. I can't see myself going to the Midlands.
No. Be a remote investor.
Yeah, exactly.
I was going to say, you've certainly got some roots anchored there. Yeah. So looking at an interesting thing, as a futurist, you've mentioned that you look at data and you change your mind, or you maintain a flexible approach to your thinking based on the data that you read. What sort of data sources would you advise the audience to look at that you monitor, shall we say?
That's a great question. My a couple of my favorite data sources actually, the ONS, Office for National Statistics, the OBR, Office for Budgetary Reform, and the Bank of England. At a very macro level, I don't think they're better than those three. All of that data gets reproduced and republished in lots of other places. But what I like about the ONS, for example, is that you can go there and get very specific data in spreadsheets and just download the spreadsheets and then just create your own tables.
Yes.
And just look at the data in different ways that suits you, not necessarily what the newspaper article wants to show you. And so I agree, the ONS especially, if you look at their house price data, they look at it by region. You can even find it sometimes by council. And so you can look, how a house price is doing in your local area or in any local area and just cut and shape and look at it. So that's really good. I also think I like, to be fair, the good thing about these days is there's so much data out there. I like to look at places like Deloitte, which is a consultancy.
Yeah.
They produce lots of reports. They had EY, Ernst & Young is another one. They have something called the EY Item Club, ITEM.
The IT Club,
yeah, they produce really interesting reports. When it comes to property, the CBRE have really interesting data analysis. I prefer to go and look at the data and then form an opinion, as opposed to read about someone's opinion of the data. And so I typically go to those data sources and just see what is their data showing them, what are the prices doing, what is the trend. The type of data I like to look at is consumer spending data. I think that's always really important because that's what I call a leading indicator. So it tells you how people are thinking. What I'm buying today is not for anything I'm doing today, it's probably for something in the future. If it's my son's birthday next week, I go shopping today. If I'm feeling flush, I buy him today a £300 present. If I think actually I'm not feeling so flush, I buy him a £30 present. So if I see today that actually spending is at £300 level or is at £30 level, I know in the future they're expecting things to look good. And if I'm looking for tenants, for example, I mean, if we bring it back to property, one of the reasons why I invest in Harrow, for example, is that I know I've looked at the trend of income in the area and it was up. So that meant either that the people in the local area were earning more and they had a good growth rate, or people were moving into the area earning well. So that's a trend that I can look at and say, actually, this has shown blah, blah. This is a good area for this type of tenant, etc. And all of this data is public. All of this data is out there and all of this data is for people to see.
Yeah. So what you're looking at and predicting from those different data sets is public confidence, because public confidence, i.e., I might be on furlough, but I'm confident my job's going to stay around, so I'll spend heavily on my children's birthday present. Because people are feeling confident, they therefore spend money with businesses generally. Businesses therefore get dragged along behind doing well, which then means they invest in either more people, equipment, and it becomes a virtuous spiral upwards or downwards if confidence is declining. So based on data that you might have been analysing over the last 12 months or so, and I imagine you've been analysing and reanalyzing and probably analysing again an hour later.
Yeah.
What do you sort of predict for 2021? Do you think it's an upward spiral, a downward spiral? Do you think it's just a wobbly line? What are key events for you that we should look at?
That's a great question. I think 2021 is really going to be tell all, because a lot of the government measures that were implemented created a false support, if you like, for things like consumer spending. So, you know, things like furlough created cash, put cash in people's pockets, but it stopped unemployment. So it was great for the short term, but how long is that going to go for? And we know that ends in April. So what's going to happen post-April when people are no longer able to get government payments to support them? I think that's going to be a really interesting point in terms of what the government does around rising unemployment.
Apropos,
that's really key.
Furlough, sorry to interrupt, but if I'd been an employer back in March 20, all the people on furlough, I'd have been saying to my managers, well, what does that person actually do? Let's look at that role. Do we need it?
Yeah. And I think there's two elements. So you're right. The one is looking at what you're doing now. Do you need them now? But the other element as a futurist is looking forward, projecting forward, and then saying, actually, what is our business model, operating model? What is our target operating model in 3 years' time? So this is where people like me earn their money. But you look at post-pandemic target operating model planning. So actually, what does our business look like in 2 years? What is our people plan? What is our location plan? How do we merge those two things together? Is everybody working from home? Do I need everybody to be in London? Can I now hire people in China to do the work that it was done here? Can we afford to let people go because we expect economic activity to fall away for 12 months and then pick up again in 2021, in 2022? So that means actually I can let half my staff go now with a view to hiring them again later. And this is all what's going to happen once the government start to make clear what they are looking to do with their furlough plan. So rising unemployment, I think, is really a really tough metric. The other one is the vaccine, to be honest. So the government has pinned their hopes of opening up economic activity on a vaccine. That's been clear for a long time, right or wrong, who knows, but that's been the plan. And in that way, once depending on whether the vaccine is effective and depending on uptake of the vaccine, if we reach a point of criticality in terms of herd immunity, we can then almost flip the switch where everything is open and the people who are at risk are isolated. And so that's really going to be key in terms of what happens economically as well. So putting those two things together, the economic scarring that has happened as a result of the pandemic and the economic reopening that happens as a result of the vaccine, those two things really are going to be key. When it comes to the data, I think a lot of people coming into the end of the year, there's been a rise in skepticism, if you like, because the spending trends have been falling down, even up to Christmas, which was, if you look at things like Black Friday this year and the pre-Christmas spending relative to even times like August and July when things reopened, and then comparing again to last year, it's markedly lower than you would expect it to be, given that there's very little activity externally going on. You can't go to the pub, so why not go shopping on Amazon? Well, it seems that less people are doing that, and so that's interesting.
It is interesting, and it's making me ask the question that I can hear the audience asking. Is this, number one, people conserving cash and building reserves because they've just been in a bit of a storm, they're buffeted around in their boats, and they're sitting there thinking to themselves, whoa, we need a bit more of a comfort blanket if another storm should come along in 2021? Or is it that people's lifestyles have changed because 2020 has been a button reset for them, where actually what's more important is quality time with the family, spending it at home, doing things which are not about having a Ferrari, a Gucci handbag, or whatever the good or chattel is. It's now about people rather than chattels.
I think so. Coming to the data, you're right. So you can see this in the data in terms of what's been bought. So people are buying things like from home goods stores, furniture, household stuff. People are spending a lot less. Like when the pandemic first started, one of the things that had a huge increase was makeup.
Oh.
Yeah, it was really weird. I'm like, so wait, you're not going out your house, you're wearing more makeup?
Have I got the right side on? Enough blusher?
Yeah, I knew it was you. But I was a bit upset because I was like, so all of these people going out into the real world with their real face on, but now that they're on Zoom, they want to wear makeup? Come on, show me some respect in the real world.
Wow.
Anyway, but
another interesting correlation, just butting in very, very quickly, a sort of wacky one you wouldn't expect is scented candles, because you and I know that there's an impact on the sense of smell from COVID. So an early way to track it is the sale of scented candles, because then people can't smell, they stop buying them.
There you go.
So there we are.
I didn't know that one. But yeah, I think a lot of the trends that we see now, post-COVID at least, if we're talking about scented candles and talking about people being at home, are more around things like home goods, furniture, scented candles, plants. So actually, you know, that homeliness is definitely a factor. So your second point, I hope actually, that people are finding more sense of well-being while being at home and feeling better in that way. I think the first point is two-tailed. So if people are saving reserves in order for a save or a rainy day, that's a good thing. If people are saving and putting into reserve because they think that bad times are coming, that's not necessarily a good thing. So what we don't want to do necessarily is get into a deflationary spiral where people think, actually, I'm going to save, not spend. And then as a result, prices start to fall because nobody's buying. And then as a result, they think, well, actually, things are falling, so I'm not going to spend. I'm going to keep saving.
Yeah.
And then we get into that spiral. And yeah, I think that's where we don't want to get to. But look, if we look at where we are now in terms of 2021, 2020 saw retail investors piling into assets. You know, we spoke before this about Bitcoin. Now, Bitcoin was up 300% in 2020. That's huge. I mean, on today, it was down 17% at one point on the 4th of January. But that's the volatility, and that's the retail investors getting into it. Stock markets, global stock markets have been up, you know, post their pandemic lows in March. They've been up, and this year they're still going up. Likewise, property prices up 7.3% on the year, up more, almost 6% between June and December alone. So I think that tells me that there is the demand for return. You know, there's this phrase we have, which is in banking called a TINA. There is no alternative. And so where there is no alternative, people will pile into the real assets, making real returns in this low interest rate environment. Property in particular has really low volatility. and has seen a huge amount of participation. I don't expect any of those things to change in 2021, to be honest. I think there's two sides to it. You know, the broader economy, I don't necessarily hold out much hope for in the short term, but that's actually to the benefit of property in the converse way, because it's seen as safety. And so, you know, in the search for safe haven, whether domestic or international, people look at retail, residential, and commercial assets as a safe haven asset. That means that we see things like today where UK mortgage approvals reach their highest level since 2007. And we you know, I don't see any of those things changing. Sorry?
Today, 4th of January 2021, that
Yeah.
date is out. The highest level since 2007.
Good
Yeah.
Lord. Who would have thought that?
Well, this is the point. So, you know, I don't expect that to change. I think that even if we get a slowdown, it's going to be a slowing down of the growth rate. So instead of going up 7%, we might go up somewhere up to 4% or more, between 4 and 7%. And my prediction, really, I'd say probably 3 and 7% growth rate nationally is wholly achievable. In you know, regionally, you'll probably be higher than that. In certain quarters, could be seeing double figures growth in some parts of the country for a certain 3-month period. I don't doubt that at all, especially sort of in March. So I think the data supports a lot of that. The concern I have is more for urban areas, inner city areas. I think those areas, and actually, for the concern I have for myself, I do HMOs. For the best part, HMOs were really successful because the low price point, many things, but in the world of social distancing, it's a little bit of a different scenario where, you know, do you want to share a house with from 4 to 8 other people where you don't know who they're interacting with, who they're socializing with.
Yeah.
So that
especially
changes
when one moves out and one moves in
on a regular basis.
Yeah.
Even if they don't move out, move in, who they bring into the house. If each person brings one other person, partner, you know, you could have anywhere between 10, 16 people frequenting the house. Do you want that? So it's just the psychology of that. So I think
you've
the type
also
of
got things like furlough, where employees are either working from home, so they're living at home, so they're on Netflix, Amazon Prime, or, you know, Sky 24/7, downloading and streaming, or their employer has said, tell you what, I'd like you to work from home because it would be beneficial for my business, because I don't want you giving your germs to other colleagues. Therefore, you're in a HMO, sat on the end of your bed with your laptop, trying to do a Zoom, not looking awfully professional and actually wanting to get out the room, but you got nowhere else to go.
Exactly.
Yeah.
So I understand why you're reviewing the model based on that.
Yeah, I mean,
as a futurist, are you sort of predicting that this cycle of virus might recur on a more periodic basis? Therefore, there's a structural change to our society being undertaken at this moment in time.
So this is a great question. I mean, the thing about this virus is, if you look at the way it's been dealt with actually by different nations, and I put those nations actually more in continents. So if you look at Asia, Africa, North America, South America, Europe, they've actually all taken different approaches to dealing with the virus. Well, for the best part, America and Europe have taken very similar approaches to dealing with the virus. Asia took a totally different approach to dealing with it. Africa took a totally different approach to dealing with it. And so whether it's here to stay is a really interesting question. I think Europe is going to struggle the most with it. This is the irony. Europe and America are going to struggle the most with it. I think in those locations, it could be here to stay. In those places, it could be here almost as seasonal flu, something that we suppress but never get rid of. And so the other irony is that this year, seasonal flu has been at its lowest levels because we suppressed it with the measures that we've been taking for COVID. So distancing, hand washing, all of those things suppress seasonal flu.
And
but
it's not only the fact that sorry that we're a democracy and people are allowed to sort of float around. It's also to do with, I think, is it the 31st parallel and sunlight and vitamin D, and I think that the parallel that cuts right through the state of California, so that in Northern California they're far more at risk than in the South.
Yeah, so I mean, those are all theories. I don't know the evidence, but if, for example, around the equator periods, around the equator locations.
I'm just showing you this is going to become the norm. Your COVID passport. I've had the vaccination, and like you say, New Zealand, Australia shut the borders totally, blocked everyone out.
Yes.
Yeah.
And it's probably going to be, most people are going to have to carry one of these, which is a COVID passport, to say that you've been vaccinated in order to go to pubs, clubs, networking events, or whatever.
But Taiwan and these countries that shut their borders, they can only do it for a while. You can't do it forever.
No, but then if you do, so then how do you let people back in with a passport or with some other proof?
Well, they've got to be vaccinated or
whatever.
That's the only way.
Only way.
Yeah, I mean, the question about the vaccine is long-term immunity. Yeah. So, like the flu, you have to have the flu shot every year because the flu changes. And the new strain of the virus, they think that it's protected, the vaccine protects you against it. The extent of any immunity still to be determined, the length and time scale of it still to be determined. I think the places like Asia, if you take Asia, for example, they've been able to suppress the virus.
Yes.
And then they flip it the other way. And so people who have the virus are the ones who are isolated from society, not that society is isolating to protect those people. But they have a different mechanism. They have a more robust technological way of doing it. And they have the ability to do those things in, much more controlled way than we can. I mean, for a start, they just better at the technology. So,
well, they've got smartphone apps, and those smartphone apps,
they actually work
a lot more.
They worked in March. This is the thing. They worked in March.
Yes.
So in March, Singapore had an app that everybody had to download that could track you, tell you when you've been in contact, check if you've been isolating. And the app will tell you when you left your house and tell the police that you've left your house. So, they didn't have to shut everyone down because that one person in the community that was infected was managed.
Yes.
But that's Singapore. Singapore did it. Taiwan shared the land border with China. They've had less deaths from the virus than I've had in Harrow. Like literally, they've had 3 people. And so how did they manage to control it? So I think it just depends. In Europe, we're going to struggle with it. We're going to struggle with it for a while. We're going to be relying on the vaccine in order for it to be effective, and all of those things. So for us, I think it's here to stay in some form. And in order for us to go to Taiwan, we might need a passport, or New Zealand, or Australia, we might need a health passport because they've managed it differently and they don't want us to bring it to them.
I think that's very likely.
Like in those countries, I think they will have a lot of normality back. New Zealand, they'll be very normal very soon. Only the Brits coming there won't be normal. You have your vaccine passport, you might have to isolate when you're there as well. So I think
the thing is, what's not clear is if you've had the vaccine, are you still a carrier that could infect other people?
We don't know.
Still so much we don't know.
But we've deviated slightly off agenda there.
Yes.
I mean, the housing market itself then for 2021, you see things like the relaxation of, or the rewriting, not the relaxation, the rewriting of the planning policy.
Yeah.
The first in 50 plus years. The relaxation of permitted development rights around what is now Class C, where lots of different commercial assets have been grouped into one class, will stimulate the market, stimulate development, or do you see the housing market just sort of ticking along nicely without too much of a problem, having an effect on commercial asset prices at all? What's your sort of take on that?
I think, so start actually with stamp duty. I think that's ripe for change. I can see this chancellor changing the tax regime quite fundamentally. if I'm honest. I think he's already made his name, and he's a very flashy guy. He's going to want to do something to leave his mark. And if you look at everything that he's done so far, which has been more on a people pleaser perspective, there's nothing in it about the other side of the equation. So in order for him to be able to do anything on that side, he can't use the traditional mechanisms, because all you have to do is increase taxes and reduce spending.
Yeah.
And I don't think he wants to do that. So he's going to have to fundamentally rewrite the rule book in order to be creative with it. And so personally, I think that stamp duty and capital gains tax are ripe for redevelopment. And, if you're in any asset, physical, that's going to hit. So
I think in the way that they've chucked the baby out pretty much with the bathwater, in chucking the whole planning system out and rewritten it.
Yeah.
It's almost like, I'm a chartered accountant by background, as you probably might recall. They're going to chuck the tax system out the window, write a new system, and because it's been rewritten, whereas we might say, oh, he's put 1% on VAT,
exactly,
tinkered with the capital allowances, he's tinkered with the tax rates on capital gains, he's messed around the edges on income tax and pint of beer. If we chuck it all out,
he's going to rip it all up
and write a new system, actually you've got nothing to compare to whether you're better off or worse off.
Yes.
And you might be on the money.
That's exactly it. And so and I think as I go back to it, this chancellor in particular, this chancellor, he's not going to tinker with those bits, because then it'll be clear what he's doing, and he doesn't want that to be his legacy. So he's going to rewrite the whole rule book in order to be able to, it's not going to be clear. And then when it is clear, he's going to be long gone.
Yeah, agreed.
So
a bit like a Gordon Brown budget that often took a week or 2 weeks before you actually found the things that were going to bite you on the bum.
Yeah. Gordon Brown was a master of that. Brown was a master of that.
Yeah.
And I think Rishi Sunak,
he's smart.
He's a very smart guy, but he's also a very flashy guy, and he likes the publicity. And I like that about him in the world. There's nothing wrong with a people pleaser. There's nothing wrong with a people pleaser, and he's out to please the people. He wants to please all of the people. But the downside to that is that he's not going to make it easy for him to be criticized. So everything that he does, go back and look at all of his measures that he's done, he's had to revise most of them. Because he came out and, the guy was so eager to please, he didn't fully think through what he was doing. We're going to give furlough to everyone. Oh, wait, actually, what we really mean is 80%, and you have to make up the rest. Or even the converse. We're not going to give furlough to everyone. Wait, no, sorry, we are. I didn't mean that we weren't. I meant that we are.
Yeah, I remember having to analyse the documentation that government were releasing and advise the property sector back in March what actually was going on and what it meant for them, whether this rent deferral and mortgage payment holiday was a good thing, a bad thing, or whatever.
Exactly.
Now, coming on
to be fair, I think the jury's still out. The jury's still out on that question. I think one thing that people aren't necessarily, or maybe are now, is the longer term impact of all of those things, what that means if you're looking to refinance, what that means in terms of your credit rating.
Well, let me flip this one to you, because this is something that I know we spoke about earlier, and it was about the fact that I am a business and I've bought myself some property assets, let's say commercial property, and I used to have Debenhams as a tenant. Now, I had a good cap rate on it, so I'd got great finance, really cheap finance on it, and I was operating within covenant. Well, Debenhams has gone to the wall, as an example. As a result, the valuation and the cap rate no longer apply. So the lender is likely to come in and rebase that facility, requiring me to potentially put cash in to get the loan to value within the lending limits. Also, because Debenhams had taken a rent deferral and now have gone bust, I'm not going to get anything.
Yeah.
So the mortgage deferral I might have been having is now problematic for the bank, because I'm never going to get that money off Debenhams. Where does that leave the market? I mean, for someone within the banking sector, how do you sort of look at those dynamics?
Yeah, this is a great question. I mean, so back in March, these are the type of questions I was being asked in terms of when the lockdown first happened. You know, what does that mean for companies, those that are already in trouble that we know about, those that aren't in trouble but could be in trouble as a result? And then Debenhams is a good example. I mean, they're ultimately, unfortunately, the bank is always involved. So either across the stack, the bank is involved. Now, what that means in the long run is that a lot of the banks have something called bad, if you look at it purely from a banking perspective, post 2007, the global financial crisis, there were a number of different rules that came into place for banks because they were systematically important, too big to fail. So banks have to make a lot of bad debt provisions. In fact, if you look at since 2008, it's the number one reason why the banking sector, in terms of the stock price, haven't moved much, by a few American ones. And that's mainly because of investment banking, not necessarily because of commercial or retail banking. But the reason for that is because they have to make a lot of bad debt provisions. They often have to, sometimes, depending on the debt, they have to put the exact amount they're lending away in case that debt goes bad.
Well, it's the Basel funding formula, isn't
But
it?
yes, exactly.
And I understand, having worked in banking myself and an accountant, I do understand what you're saying. And if it gets worse than that, because if a loan trips over into arrears, they don't just have to put pound for pound. They have to put £1.25 or £1.50, I think, is usually the worst case set of reserves for every pound you've lent.
Yeah, you know, there's new rules actually that came into force this year, based Prudential, Bank of England, where in some scenarios, if the loan defaults one set of arrears, you have to put the whole loan as bad debt. And so you basically recognize it. Actually, let me go further. It's worse than that. If you think the loan is going to default, you have to put it down as a defaulted loan, even if they haven't defaulted on any arrears. So if you look at COVID in that context, where you're seeing a lot of information about companies, some of those companies may even be keeping up with their debt, but you might see on the news that actually they're really at risk of paying. You have to default their loan, even though they're making the repayments on the loan. So these rules are tricky, and they're not good for banks.
Effectively, that could be a tipping point to tip businesses over the edge, because finance and liquidity in the economy gets all of a sudden sucked into a balance sheet of a bank to prop the bank up, to protect the bank, which then falls down.
Self-fulfilling prophecy, doesn't it?
No, exactly. But to answer your question, so up till now, a lot of this has been held back because of guidance from the Prudential Regulatory Authority, the PRA. They've been, in the UK especially, encouraging banks, and in Europe too, actually, encouraging banks not to be so aggressive with bad debt provisions and recognition of this type of problem. But as with everything, there's a cutoff. So they'll get to a point where, either from the bank's perspective, they need to be able to do something in order to either pursue the debt or recognize it so they can write it off, so that they can do other things with the money. And so they will get to a point, unfortunately, where, like, take Debenhams, for example. Debenhams will have creditors. Some of those creditors will have creditors who are banks. And the bank, for now, might give some deferral on those debts, but it'll get to a point where they'll call all of that in. And if there's assets, good. If there's no assets, there's going to be other things the bank will probably look. But to your point, I think purely from a financial, we're not going to get a financial crisis this time around because of all the provisions that have been made and all the things that banks have had to do since the last one. That doesn't stop the problem in the broader economy. And I think a lot of the stuff that has happened has helped, but delayed that problem. And they'll probably, so we talked about property. I think the prices are going to keep going up. economically, I think the worst of the economic downturn we haven't looked at. Probably the middle part of 2021 is when the reality posted, what, May, June, July, we're going to have a hard summer. And that's when the economics of everything that's happened is going to have to really come to the front. And I think that's probably when April, the spring budget really is going to be key, because that's when Rishi is going to have to come up with a plan. At the moment, he has no plan to pay back a single pound that he has borrowed. And bearing in mind that we are operating at something like 4 times the level of spending that we were during the worst of the financial crisis that we had to have 10 years of austerity for, now we're doing worse than that with no plan to pay it back. So he's going to have to come up with a plan sooner or later. We're talking probably this year.
Can I be a devil's advocate? Do you think the money will ever be paid back?
No.
Or do you think it will remain in the economy? Because if we pay it back, we then start to contract the available cash within the economy, which some of that cash may have gone into gold and other assets. Therefore, it was sort of taken out of the economy and recycled around again. I'm being devil's advocate.
So on the one hand, the QE money will be paid back, but that's an accounting trick.
Yeah.
So that's fine.
I appreciate that. I mean, the audience may not quite get it in the way that...
No money needs to change hands. They're going to change things on a spreadsheet. So that's fine.
But basically, the pound in your pocket is worth 87p without you realising it.
Yeah.
You will never realise it. You will never realise it.
Harold Wilson,
in your pocket. Just that it will buy you less.
Correct.
So that's fine. The other element is the national debt. And so, we spend, George Osborne made a big point about how important it is to have a surplus. And now we're so far away. I think most countries don't run surpluses fine. We're probably not going to get to a point where we run a surplus. Is it going to be paid back? No. And to be honest, financial markets are forward looking. I mean, I'm futurist, but generally financial markets think, if you look at the pandemic in March, when it happened, financial markets tanked. And then around April, financial markets were back to the level that they were at, which basically meant that April, May, June, July, August, September, around September, they expected everything to be fine. So this is really how financial markets work. And so the debt won't be paid back. Financial markets know it won't be paid back because that's what they're projecting going forward. But what they need is a credible plan on how to pay it back. Otherwise, they'll punish you in terms of borrowing. And so the UK needs to be credible in terms of...
Oh, absolutely. But it also needs to stay in step with other economies around the globe, because if we start paying back and America doesn't, it affects our exchange rates, it affects the price of goods we import and export. So we have to keep that parity with other nations, and it is a confidence thing and a parity.
Yeah, exactly. So the debt repayments, interest rates, inflation, I think that trio needs to be managed very carefully. So, for example, if we're raising interest rates, we could probably afford to pay back more of the debt, because different reasons. If we have a bit more inflation, higher interest rates, we'd probably be in a position to pay back a bit of the debt and it'll balance out. The thing is, now that we have this low interest rate environment, some would argue that we should be taking on more debt, not paying it back, because we can deflate this debt away effectively.
I was about to say that exact thing. Let inflation erode it away.
Yeah.
Which is what I think, honestly, I'm not looking to bash George Osborne, but he missed the trick big time. Because if you look at the last decade, there's a counter argument. I'll give the counter argument after. But if you look at the last decade, had we been borrowing and spending on infrastructure, I don't know, let's say the NHS, we'd probably have come into this crisis much better prepared and therefore recovered better. The flip side is that if we'd come into this crisis with more debt, then we'd have even more debt now. But to the earlier point, financial markets just need to see a credible plan to repay the debt. They don't actually expect you to be debt free. So you know, there's 6 of one, but I argue that if we had spent the last 10 years really plowing money into our economy, roads, hospitals, healthcare, social care, that would have created more jobs, more nurses, more carers. You know, we would have had people building ventilators 3 years ago, possibly.
On the flip side of it, we'd have had more furlough to pay.
Well, yeah, we would have.
No,
Hey.
I do totally agree with what you're saying, and it is something which I have said many a time myself as well. You can probably glean that from what I've contributed, chipped in. But are there any? I'm conscious we've been running for around an hour now. Are there any pearls of wisdom that you'd like to share before we wrap up? And if you're out there in the audience, do you agree with what Kwasi said? Do you think he's talking hot air? And if so, why? And if you've enjoyed this, by all means, hit that share button and share it with your mates. Give Kwasi a big thumbs up because he'd love to see some positive feedback on this. And hit the subscribe button if you're not already subscribing, and you'll see more videos like this one, analyzing the markets.
Yeah, I think, I mean, look, as I said before, for me, there's no catastrophic scenario where, you know, things are so terrible. Brexit, we didn't even touch on Brexit. This time last year, probably would have thought Brexit would be the biggest thing to talk about in January 2021. Yeah. But, you know, we just spoke for an hour and didn't even mention it. The key thing is, for me personally, that I'm always looking at the horizon, always looking at what's happening, and then trying to adjust to it, trying to react to it, not necessarily thinking that it's going to destroy me or do anything bad, but actually, how can I benefit from this? How can I take advantage of this? And as we head into 2021, there's going to be ample opportunity for everyone. You know, there's no shortage of opportunity, and there's no shortage of ways to make money out there, as long as people are cognizant and open to the opportunity that presents themselves. So yeah, there's no pearls of wisdom per se, other than focus on the future, look at what's happening and plan for it. And I'll make this point. Somebody asked me, so one question I often get asked, actually, which I'm surprised you didn't ask, is what is strategy?
Okay.
Any thoughts?
Well, I've done it as part of accounting, and what an investment strategist looks at might be completely different to me. To me, strategy is working out the big goal 10 years hence, not worrying about the implementation bit. It's the vision of the future in the distance.
That's exactly it.
I don't worry about the bit in between.
That would have applied to Napoleon as well, wouldn't it?
Yeah, the thing I'm pretty good at, and why clients come to me, is I can look at the big picture down the road, but I can also draw the roadmap in between here and there as well, which is something a lot of people either can't do the 10-year map or they can't draw the road.
Yeah, no, but that's exactly what strategy is. So a strategy is a high-level plan for the long term. So, you know, I think everybody should have a strategy. Should have a strategy for basically everything. So for everything you're working on, you should have a high-level plan for the long term. And that would be my only advice.
Yeah. Well, I think Steve Jobs was one that had a vision and a strategy. He was going to put a computer in your pocket. Yeah. He succeeded. Yeah. Exactly. Very well, he succeeded. And he changed markets fundamentally from the thing with the wire in the wall through to the thing that you carried around with a car battery, right the way through to a whole computer in your pocket.
You made a point which is really succinct, and I think needs to be called out. Steve Jobs had a vision and a strategy.
Yes.
Right? Lots of times people get obsessed about their vision and they have no strategy.
Yeah.
Very good.
Very good point. Thank you for teasing that one out for the audience. That's a really great point. Thank you.
All right, so, thank you. It's been a pleasure.
Likewise. David, do you have any parting words today?
where were Apple without Steve Jobs? So we need that strategy and we need that vision. I mean, since sadly Steve Jobs left us, in my rather contentious opinion, and do comment on this below, Apple haven't done anything.
Yeah, I mean, this could be a whole different conversation. Equities
Sounds
analysis.
to me like another video, gents.
Yeah, exactly. We'll do another video, equities analysis, looking at Apple stock since Steve Jobs. But I think the thing I leave on, I would love to connect anybody out there. If you want, go to slowmoneyclub.com or find me on Instagram, Twitter, Facebook, LinkedIn.
Well, if you we'll drop your details in the box below in the comments box so that you can get hold of Kwasi. Kwasi, it's been fantastic. I must say, this is the first time I've interviewed an investment banking strategist and futurist. There you go. You're a world first for me.
Yes, I'm glad to be the first.
Thank you very much. Thank you, Kwasi. Thank you for joining us, David. And we look forward to seeing you again in the near future.